So thank you everybody for joining for the second edition of Rupee to Sampatti. We are very much indebted to all the experts who have agreed to be part of this program. I begin by first introducing Dr. Srishti Jain. All those who attended the previous program already know about her, but in her day job, she is an intensivist in charge of more than 100 ICU beds in one of the largest private medical colleges in Rajasthan, Mahatma Gandhi Medical College Hospital. But that's not why she is here today. She is here today because she is a certified financial analyst and she has some real in-depth knowledge about how to read the science, how to take decisions and invest wisely when we are having market fluctuations. So without taking too much time from her talk, I hand over the mic and the podium to Dr. Srishti Jain.
Thank you so much, sir, for your kind introduction. And yes, we all are students of market and still learning. And I think the beauty of markets is like it will always keep you a student. And I think that is, which is a big reason to live, to strive by. So we are here again to learn. And today's topic is very interesting. I think we are at a phase where we really need to understand, cutting out all the noise which is around, that how do we identify the market tops. And we will learn this from the legends of investing and the historical data which is available to us. So we will first start with Howard Marks. And Howard Marks is an investor in US. He runs a firm known by the Oak Tree Investments. And his two books are the books which I feel they are like stage one books and everyone should read. One is Mastering the Market Cycles, Getting the Odds on Your Side. And another book is The Most Important Thing. So let's try to summarize what he has to say about understanding the market tops. So everyone is exposed to some fundamental information and emotional influences. And if you respond to them in a typical fashion, your behavior will be typical, pro-cyclical, and painfully wrong at the extremes. To do better, to succeed at being a contrarian and anti-cyclical, you have to have an understanding of cycles, which can be gained through either experience or studying history, and be able to control your emotional reaction to external stimuli. So like right now, what we are seeing, let's keep that aside. Let's keep aside what's happening with the markets right now and just try to feel that if I'm invested in the markets, how am I feeling right now? मुझे अभी लग कैसा रहा है? So are we in a disbelief right now? I think no. We are not in a disbelief. Are we in a hope of a recovery? I don't think so. Are we optimistic? I think we were optimistic when we started investing again after the COVID dip in March, when the Nifty was at around 16,800. And in June last year, when it was around at 15,000, right? So those two were the moments in the recent years after the COVID dip that we got a good opportunity to buy. So we got optimistic. Then it came out to be a belief. Okay, let's get invested fully. Then we were thrilled. And now maybe we are in euphoria. Let's just try to figure out and see ourselves कि मुझे अभी कैसा लग रहा है. वाओ, जब 15 सितंबर को निफ्टी ने अपना टॉप बनाया 20,222 का, I think we all were in a big euphoria. Then some correction came and it came off all of a sudden. And October correction, September we made a top 15 September. Then now we are standing here on 23rd of November, and it's been like 3 months, and somewhere we are again hoping for an all-time high. So complacency, we just need to cool off for another next rally, and everyone is like right now कि क्या पता निफ्टी अब 21,000 जाएगा, 22,000 जाएगा, इंडिया की हिस्ट्री, इंडिया ग्लोबल, ये all that shipole which is being peddled around us. So maybe we are here, and once the market starts correcting more, maybe we'll see anxiety, then denial, कि यार मेरे इन्वेस्टमेंट गलत कैसे हो सकते हैं. I've invested in good companies like HDFC Bank, Kotak Bank, and nothing can go wrong. And then there would be a panic, like, shit, everyone is selling, I need to get out. And then I have to be angry, who shorted the market, government, why did they allow this to happen? Why the bankers were so reckless? Why were they not careful with the lending they did? Why there are so many defaulters and blah blah blah. And finally, over months and years, we'll get depressed. We like, shit, मेरा retirement money चला गया, अब मैं कैसे आगे का करूंगा? मैंने तो अपना सारा पैसा मार्केट में लगा दिया था. And then finally, when the retailers have lost all the hopes कि अब कुछ नहीं हो सकता, मेरे से गलती हो गई, मैं दोबारा कभी मार्केट नहीं आऊंगा, and then finally the smart money will start coming in, जब उन्होंने सारी bad news spread कर दी होगी, हमसे सस्ते में shares ले लिए होंगे, and then the smart money will enter and we will be in a disbelief कि ये तो साकर रैली है, फिर से फंसेंगे, like that kind of feeling. So we need to judge ourselves right now that where are we, right? So this is one of the psychology cheat sheet of markets. So recently, Howard Marks has written few memos, and I've shared the link in the bibliography in the last slide, that where are the markets heading and why this time is it really different? So US government and US people were used to low interest rates, right? Since 1980 में 9% interest rate था. Since 1980, like for the last 40 years, they were decreasing the interest rate, decreasing, near to 4% in 2008. And then after the global financial crisis, they again kept they again kept decreasing down the rates and rates. We'll see in the next few slides that what they did. So they decreased the basis point, 2000 basis point decline was there between 1980 to 2020. Can you believe this? When we actually look at the bigger picture, we were not even born, and we see that 40 years they had decreased the interest rates by 2000 basis points, right? So when things go well in the market, people forget to worry. The dance will keep going and the Fed will engineer soft landing. But this has never happened in the past, right? So this is again one of the experts from the Sea Change, which he has written. And I will just summarize it in few words, that in late 2008, Federal Reserve took the Fed funds to near zero. Since that didn't cause inflation to rise from its sub-zero level, they felt comfortable maintaining the accommodative policies. And they did this for 13 years, till 2021. And only after the COVID crash, when the inflation went up to 9%, they started again increasing the interest rates, right? So these are the Fed interest rates. And see, from 1980, they were decreasing the rates, bringing it to sub-zero during the to a near zero during the global financial crisis. They had again started raising the rate in 2016 till 2019, but then there were again inverted bond yields. This is again a very interesting fact कि हमने इस रिसेशन को कोविड रिसेशन का नाम दे दिया, बट एक्चुअली अगर हम बुक्स खोलेंगे और हिस्ट्री देखेंगे तो 2019 से ही bond yields के curves inverted हो गए थे. The leading economic indicators of recessions, they had started giving a red alert sign. But then COVID came, COVID crash came, the recession was labeled as COVID recession. And only if you actually dig in deep, you come to know that what was actually happening. So again, now what is happening? Now they started increasing the rates, and they have increased rates this steeply for the first time in the last 40 years. Now, this is the sea change, what Howard Marks is talking about, that people in US are not used to these high rates. And let's see how the time passes by and how the bankruptcies, the delinquencies, the negativity in the markets will increase over the period of the time. Now, see here that how they have been hiking the rates, right? Since March 2022, they have been hiking the rates 25 BPS points like this, and they have finally gone from 0.25% to 5.25 to 5.5%, right? This is how they have steeply increased the interest rates in US, for which they have never been prepared in the last 40 years. And now, again, going back to the history, when did they last decrease the rates? They decreased the rates when they decreased the rates in August 2019 because the economy was slagging, right? They tried that they will do a soft landing. They will decrease the rates a little bit. So they decreased from 2 to 2.25% to 1.5 to 1.75% over 3 months. Then what happened? They could at that time decrease the rates because the inflation was like around 2% target. Core PCE was 1.7%. So the inflation targets were still below 2%. And then when the COVID crisis came, they got another reason to, just cut the rates to zero and then print. They turn on their money printer. So again, that's a different story, that they need reasons to print money. What if COVID wouldn't have come? If COVID wouldn't have come, still they would have landed up in a recession. That is the most interesting thing that we need to know. Only ये होता कि recession थोड़ा late आता, COVID के कारण वो जल्दी आ गया. That's all the difference would have been made. So being a contrarian is not easy. At the top of the market, when everyone is in euphoria, when the news is in euphoria, the newspapers, the market, the social media is flooded with India this, India that, Nifty to 22K, don't miss this rally, invest in mutual funds, and everywhere there's so much of noise and trying to give you offers and lucrative offers that you should invest in the markets. FII is seeing this, Goldman Sachs is giving this target, but then it really needs a lot of patience and I would say commitment to the books and the theories you read and the history you understand, that how important it is to be a contrarian, right? Herd mentality would not give us good returns or outstanding returns. Let me say, we might get average returns, but a herd mentality would not give us excellent returns, right? So patient opportunism buttressed by a contrarian attitude and strong balance sheet can yield amazing profits during meltdowns. You want to take risk when others are fleeing from it, not when they are competing with you to do so, right? So we would see that all the influencers would have gone, no tweets, no telegrams, no one messaging you about buying the stocks. That would be the time when you have to go all in, right? So there are certain behavioral biases that affect our investment decisions. So one thing is confirmation bias. Key, I read the articles, I visit the websites, I watch the TV shows whose information I agree with. Then there is something called as availability bias. I tend to rely a lot on information that I read or hear recently. We are not open to ideas. We are not open to thought processes which are different from ours. Overconfidence. With my portfolio management skills, I'm sure that I can outperform the market. That's what happened with batch of 2020. Most of the people, especially the doctors, they entered in 2020 because for the first time in life they got so much of time. But those amongst us who have been investors since a very long time, let's say 2008, they would be knowing that overconfidence can really kill. Then there is something called as loss aversion bias, that I tend to feel really bad after a loss and gains don't excite me much, however. Then something called as recency bias, that sometimes I make an investment decision right after a big news or event or emotional experience. So like just today we saw that FIIs have started buying, and we'll see floods of tweets because that is recency bias. We tend to ignore as a human being that 3 saal se they are just selling, right? Then herding bias, I find out how other people are investing. Anchoring bias, if I bought shares of stock at $160 and the price went down, I wouldn't sell until it reaches $120 again. That happened with me at the peak of the bull mania when I bought a chemical share and chemicals were buzzing around and then it was going down. I was buying more and more and more. And there was a point of time when 50% of my capital got invested in that chemical share. I was like, सब कुछ तो अच्छा है, PE ratio अच्छा है, fundamentals अच्छे हैं, company का कोई competition नहीं है, all those things you try telling yourself, you just are failing to accept that, okay, I made a mistake, mera stop loss hit ho gaya 8%, I will get out, I will accept that I can be wrong and I will get out. Doesn't happen at the peak of the bull market. So it's very, very important. Tops are very elusive. Tops are like, you being drunk on a half a bottle of scotch. That's how the tops affect your psychology. So after we have understood about, just the key principle of Howard Marks, that understand the market cycles where you are and try being a contrarian. and try supporting your try going against to what the herd is feeling around you. Then coming to the principles of Stan Weinstein, so beautiful book, Secrets for Profiting in a Bull and Bear Market, an old book but a lovely book to hold by. And he gave us the stage analysis, and this is how the stage analysis chart would look like. This is stage 4, this is stage 1, this is stage 4, this is stage 1, and this is the stage 2, right? So let us understand what he wants to say, what is his philosophy. So his philosophy principles are that never buy or sell without checking the chart, never buy on good news, especially if the price has already risen, right? And again, I'll tell you one example. So in March we entered into stock, again no buy or sell recommendation. In March we entered a stock called as Jupiter Wagons, right? And at that time it was high around 50%. We entered the stock. No one was really talking about it in March, because 16,800 Nifty making like a triple bottom in last 2 years, and everyone had dissuaded the markets. So, and it was nowhere in the news. See, smart money will not tell you, right? They will tell you. If they are telling you, they are actually telling you because they want to shed off. They want to dump it to you so that they can book their profits and get away, and you can jump in euphoria, keep jumping, keep dancing till the time they do a rug pull event, and you are in confusion that what has happened. So after the railway theme made a top everywhere, it was right, invest in railways, G20 summit, invest in railways. Railway mein nahi dala, kya baat kar rahe? Like this is what you will hear around you. So never buy on a good news, especially if the price has been already risen. Never buy a stock that seems cheap after getting smashed. Yes Bank story, सस्ता हो रहा है और सस्ता, अरे 250 का शेयर 100 पर आ गया, 50 पर आ गया, 30 पर ही आ गया. My portfolio is 90% down with Yes Bank. So never catch a falling knife. You can really have a bad experience. Never buy a stock in a downtrend. Never hold a stock in a downtrend, regardless of how low the PE is. Cut your losses. Example of Balaji Ameen's comes in my mind, and for this very statement, I think I've done all these mistakes and living by these mistakes myself. Be consistent. If you're buying and selling in similar situations, there's something wrong with your discipline, right? So with this philosophy, we'll understand the stages of Stan Weinstein. So stage 1 is basing, right? Stage 1 is basing, and Wyckoff's principle calls this accumulation. Again, there are different names, different philosophies, but then just comes out to be the same. So every stock is in 4 stages of a major cycle. The basing stage, which can last for months or even years, and we love the stocks which have had a long basing, like a Coal India. When we started buying Coal India at the beginning of this year, and like, who buys Coal India, who buys PSU? And then silently and slowly, it was getting from stage 1 into stage 2. Very interesting chart of Coal India, a stock of 175, which was like hated on the street ki PSU se koi return nahi aata, and this bull run the heroes were PSUs. So stage 1 to stage 2. So the advancing stage, this starts with a breakout above the 30 weeks moving average. So the whole philosophy of Stan Weinstein is around 30 weeks moving average. On impressive volume, you should see a jump in volumes. Like, yeah, you should see a jump in volumes here when the stock is moving from stage 1 to stage 2. Then there is advancing stage, and this starts with a breakout above the 30 weeks MA. At this point, the fundamentals may not be positive. People are still hating the stock. The 30 weeks MA should now move up sharply. And after some months, the progress of the MA will slow. The price will approach the moving average, right? And then don't chase a stock that you've missed. Buy early in stage 2, right? So you should buy here. Ab Electra Green Tech miss ho gaya to miss ho gaya. Jupiter Wagons, RVNL, SJVN miss ho gaya to ho gaya. Koi baat nahi. There are more than 6,000 stocks listed. And if you start understanding the philosophy well, you don't need anyone to guide you. Right. So this is about stage 1 and stage 2. Then today's topic, is about talking about the tops, and what we really want, what we really are interested in here is to understand that how the top will look like and how we have to save ourselves from the top. So so the top, where the stocks trend sideways, stage 3 is the mirror image of stage 1. Improving fundamentals, न्यूज में आ रहा है, बेस्ट कंपनी, बेस्ट स्टॉक, और ऊपर जाएगा और आगे जाएगा, ऑलरेडी 300% रिटर्न दे चुका है, देयर विल बी अ स्टोरी ड्रॉन. Improving fundamentals or a story will draw in buyers, allowing others to leave. The traders should get out here. Investors should bank half their position and place a stop below the support. And then finally will come the declining stage. Like what happened with Bajaj Finance just made a 8,000 rupees. Bajaj Finance, buy more. And then finally, we all were like confused. Yeah, अभी तो 8,000 पर आया, पिछले 2 साल बाद तो 8,000 पे आया. And then, अरे ये तो टूट रहा है, अरे यार ये क्या हो रहा है, denial. यार, it has broken 30 weeks. I mean, now what's wrong with Bajaj Finance? And then the RBI news will come in later. So they know, the big people know, they know far more than you. And you will always be oblivious to the facts if you don't understand reading the charts. They will dump the shares to you in the top after making a saga story. And we'll see how the stories are cooked and what in reality they do, right? So then comes the declining phase. The price breaks below the support, get out, whatever the fundamentals are saying, right? I really got trapped badly in few chemical stocks at the peak of the bull market in 2021. And there are certain things which you really learn hard in life. So the tops. So legitimate topping patterns show active distribution. This is how the stage 3 top, the distribution would look like, because strong hands are taking profits and moving back to the sidelines. There's no perfect time frame for the completion of a top, making it easy to get caught in poor reward risk scenarios, which I probably think is happening right now, especially with short sales looking to profit from a breakdown. So you can't even short sell the market, because you never know for how long it will consolidate on the top. A mature top tends to lose elasticity with price bars failing to reach the upper half of the range. This limp price action exposes waning interest by the few enthusiastic buyers left in the system, in turn allowing gravity to take control. Intermediate moving average start to align with key support levels, adding energy to the subsequent breakdowns, which sets off a positive feedback loop. And finally, everything capitulation would start. So the technical domino would fall one after the another, while trapped shareholders are forced to capitulate. Right. So as an investor, what is the ideal time to buy? The ideal time to buy would be when no one is liking the stock, people have forgotten about it, it has been consolidating for years together, and no one wants to own that stock, and you see silently accumulation going on by the smart people. They will never tell you. Okay, they will never tell you. If they are telling you, they basically want to offload. So they have started accumulating silently. They know how to play it. They will accumulate without the price getting too high. Niche upar wo consolidate hota rahega, and they will make sure that you don't come to know about it unless it is a stage 2 nearing to an end and they really want to get out of it. So whenever we see such steep rallies, they are less bullish. So this drop down, which is so steep, and then you suddenly again start seeing up move, we don't want to invest in such stocks. We want to invest in stocks which have had a nice consolidating base for as long time as possible, right? So and then again, when the markets are going on the top but then suddenly start moving down, that might be not that bearish as compared to a top which has been consolidating for very, very long. That would be the most bearish. So when to buy? There are 3 good times to buy. When the stock moves out of stage 1 into stage 2, it can be even safer to wait for the initial stage 1 buying frenzy to die out and buy on the first pullback. This lets you confirm that volume picked up and then contracted on the pullback, but you will miss some big winners by waiting, the ones that never pull back. You can also buy a starter position in the initial breakout and double up on the pullback. traders would probably buy the breakout, sell the pullback, and then buy again. But again, as an investor, for us, the best time to buy would be just when the stock is coming out of a nice long consolidation and then breaks out with volumes and start moving above 30 weeks MA, and the 30 weeks MA also starts moving upwards, right? Now coming to one of my favorite third authors, and that is William O'Neill. So William O'Neill used to write in Investors Daily, and he is known for being one of the finest first investors to incorporate computers into his research and investment decisions making a process. He developed the Canslem strategy, which is a bullish formula for determining which stocks were likely to grow. And so he gave this Canslem theory, and beautiful book, How to Make Money in Stocks. And the Canslem theory is basically a short form for CANSLIM. So C stands for current quarterly earning per share. They should be rising. Annual earnings should be in an uptrend. The company should be, giving new products, new management, new highs, supply and demand. So supply should be less, demand should be more for the stock. It should be a leader in that sector. It should have institutional support. And the most important part, which we forget, that the overall market direction should be a bull trending market. It should not be a consolidating market. So like right now, if you ask me that, is it the time to buy any share? I would be really, really skeptical. And this would be the time to either book my profits in the stocks which are breaking 30 weeks MA. Like thanks to the system, I was out of almost every bank at the very beginning of the year when banks were breaking 30 weeks MA. So, and I think there's still a lot of room for downfall in Bank Nifty. But again, let's see. Time will only tell. We are just trying to learn from the history. And we are not forecasters here. We're just observing the history. Right. So William O'Neill ka favorite pattern is cup and handle pattern. And he plots 10 weeks moving averages on his charts. And what is the volume? So price action based on the volumes, based on the 10 weeks MA and these fundamental principles. And if there is a nice cup and handle breakout on the weekly chart, on the handle part, on the pullback part, that would be the buying point as per him. And we should also see that when we enter, volumes have already dried up, selling pressure has gone, and now all the longs are building. And jitna bada cup hoga, that longer would be the consolidation. And these are the stocks in which we really want to enter, right? So he says that you should know how to read the charts. Like if you don't know if you don't know technical analysis, you would be dependent on so many things on which you really can't trust. So I think this is one thing. If you're really investing into individual stocks, I think one should take efforts to learn technical analysis, like you learn how to see chest x-rays. Then you need to understand supply and demand. You want to invest in stocks which have a very low free float. What do we mean by free float? That means most of the stocks are with the company owners, promoters, FIIs, DIIs, and very less for the public. That's what in an Indian context we would like to understand, that supply should be less and the demand should be more. So again, one principle which you really learn a hard way, and that is cutting your losses. If you accidentally enter at the top, seeing your WhatsApp groups and seeing the social media and buying the euphoria of our news channels, then okay, fine, it can happen. You're just a human being. But I would say that one thing which should be really based on system is your stop loss. Koi baat nahi, galti ho gayi. It's okay. I will accept. I can be wrong. Okay, I will accept my mistake. But if I have taken a wrong entry, I will not wait कि recover होगा. अरे अच्छी company है, अच्छे fundamentals है. It will recover. Don't wait for that paradigm. That's what William O'Neill says. Again, market direction. Now, this is something which we really tend to forget, and you are likely to lose money even if you're investing in a good company with a nice stage to chart. But if the markets start falling, then Nifty and the Bank Nifty start falling, then less likely that likely that the breakout would fail, and you might not be able to make big money. So again and again, he reiterates that sell your stocks the moment its value drops by 7% or 8% from the price you bought it. और बाद में अगर आपका 1000%, 1500% गेन हो गया, अच्छा गेन हो गया है, then you can, you know, accept a drawdown of 20%, right? So first of all, lock in a good gain in your portfolio. Then only you can say, okay, I will broaden my stop loss. But agar entry galat ho jaye, you know, entry galat ho jaye, so what will happen? That, for example, you buy a certain share for 100 rupees and you keep on waiting, it comes to 50 rupees. Then from 50 rupees, it has to gain 100% to come back to your buying level. Right? So that is something which we really have to remember, that a 30% loss requires 50% gain to break even, and a 50% loss requires 100% gain to break even. So don't think कि इसी stock से मुझे कमाना है, नहीं, ये गलत कैसे हो सकता है? So you know, we have to learn to accept where we go wrong. Entry price is very important. I can't buy this ship all that it's okay, whatever price you enter, it's fine, it's a good company, I'm a long-term investor, you know, all that is I don't want to say that word, but I think you all got it. So how to differentiate between a market top and a normal bull market correction? Now this is something really interesting. So what does he say? He say that first the average moves up to a new high, but with a low volume, right? Then we see that the demand for the stock is poor. Second, the volume surges for several days, but there is a little increase in closing price. In that case, there may not be an increase in volume when the market initially tops, because the distribution has taken place on the way up, right? Another way to understand the market direction is to focus on how the leading stocks are performing, like how my banks are performing, how Reliance is performing, how Bajaj Finance is performing. A major sign the market has stopped if the leading stocks of the bull market start breaking down. HDFC Bank, Reliance, you know. Another important factor is the Fed discount rate. Usually after the Fed raises the rate, the market runs into trouble, which we have been saying. The Fed has been raising rates like anything. We have not seen this steep rise of rates in the history of our lives, right? While talking about the relative strength, he thinks the key point is how far a stock has extended beyond its most recent price. And we will see that the relative strength of the RSI is weakening. Right. So this is the chart of NASDAQ in 2007, that how we could have identified distribution days. So what William O'Neill says is that distribution is simply another word for selling. If you see on the major indices that they are closing down 0.2% or more in their volume, heavier than the prior day, at the end of the market top, right? I think Purvish sir, this is the best timing you could have organized this talk, that because we all will be having a great opportunity to learn and apply this what we are reading right now, that if we are seeing more than 0.2% of volumes in the prior days, in the previous days, which we saw in the end of the October, and after 15th of September, we have seen these distribution days, like 5 or 6 distribution days we have seen. But again, they are not fitting exactly into William O'Neill philosophy because they are spaced out. What he is trying to say is that they should be, you know, closed. They should be like very close to each other. So if the price drop comes on a lighter volume, that would be less worrisome, and it would indicate the selling wasn't that aggressive. But on distribution days, big price drops comes on rising volume, which shows institutional selling. So this is what we have to understand and be cautious about. So these distribution days, if a count of 2 or 3 are there, then they might be benign and normal, maybe continuing uptrend. But when the count increases to 5 to 6, one should be prepared to get his or her position trimmed. So this is what we have to watch for in the coming days. So let's see an example from his book, A History of Apple in 2008. So Apple weekly chart, Apple again was a good company, but then this is the chart of S&P 500, and Apple 4 weeks in a row there was a tight closing prices. You know, this is how the Apple share was falling along with the S&P 500. And then what they saw, that a support was being built up from the same price. You know, it was taking a support thrice, it took a support, like for nice few weeks it consolidated, and the market had also crashed to new lows, but the Apple was holding above its lows. Like Apple was holding here, market was getting new lows, but the Apple was holding its new lows. And then the bear market ends in March 2009. S&P had fallen 58%. Leaders were off 60% and coming off lows of potential teacup basis like Crizzles and Xerox and Laos. And this is what we saw, which happened in Apple. So again, historical charts, they really help us a lot to understand that how we have to keep ourselves calm and composed. God forbid, if we land up into a recession and we see 58 to 60% cuts in the broader markets, we have to be mentally prepared that this is the opportunity of my life. This is once in a decadal opportunity and I have to jump in. And this is where I have to call it risk on. That means equity on. And this is where I have to enter. Right. So coming to learning about the top from R.D. Wyckoff. So R.D. Wyckoff, again, he was an American stock market investor. He was, there in times of the Great Recession. And he proposed a 4-stage market cycle. And his idea was that cycle resulted from the actions of these large players who planned their operations in the market to take advantage of the uneducated public's inappropriate reaction to price movement. I was so happy to read this, that, a decade ago, someone was talking so honestly. And so let's see what he had to say. So he said his laws were like, the direction of prices is determined by the law of supply and demand, the law of cause and effect, and the law of effort versus results. So let's try to decode what he wanted to say. So according to him, there was an accumulation area, right? This is the accumulation area when the stocks are like oversold. Retailers like us would be hating stock market. We would have read news of people committing suicides, people getting bankrupt, and all bad news will be around because they really want to get stocks cheap from us, because they want to make us realize, okay, this is the end of capitalism. No stock market, no more stock market. Stock market will die. Like these kinds of thought processes will be, tried to be fed to our minds. And this is where the smart people would be accumulating. Why Warren Buffett is sitting on 158 billion pile of cash is because he is waiting to capitulate on this event that might happen in coming years. So oversold would be the accumulation area, demand greater than supply, then there would be a markup phase, then an overbought or a distribution phase, and then a supply greater than the demand, that is the markdown phase. So let's try to understand what he has to say. So this is the accumulation phase, right? So accumulation phase, bad news around, selling climax, lower circuits. Then there would be like some uptrend would come, then again down, then up and up in tight consolidation range. What he calls as a consolidation trend. It would be a range bound market, and finally you would see again a spring, right? And then you would see that it is starting to jump off on the creep. Now, smart investors are really smart. They don't let the prices rise a lot in the accumulation phase so that they all buy it really cheap, right? And they all are able to board it really cheap. They don't just buy in one go. They slowly they start accumulating the shares, and then we see the effect. This is the cause, right? And this is the effect, that is the markup phase. And we will see very low sell-offs but higher highs, and lower lows, higher highs and higher lows. And then finally, when they want to get out of the market, equities are best. Invest in mutual funds. India story and this and that, and Nifty 225K. This is how they will try to sell you. They will make now the social media, I think, is the new nuclear bomb. Like they will make these stories viral about India's $4 trillion economy, India this, India that, G20 summit, Chandrayaan, Falana, and like so many things. All good news is around, and then you'll be confused that all the good news is around, why my portfolio is not rising. Yeah, Nifty is cheap, then why my portfolio is not rising? And there they would be slowly distributing, and they would be making sure that the prices don't fall much, right? They would be making sure that the prices don't fall much, and there would be a buying climax, sudden upward circuits, and another upward circuit to make you into euphoria. 20% rallies, these are called the climax rally. If you remember what happened on the climax day of IRCTC, like everyone was mad about IRCTC. I think every retailer was into IRCTC, including me. And I still remember there was a climax move. On one single day, there was an upper circuit of 20%. And same day by afternoon, there was a lower circuit of 20%. Like in one single day, it had shown moves or like 40-50%. It was just crazy. And buy IRCTC, buy IRCTC. Oh God, this is it. This is the end of the world. If you don't have IRCTC, you have nothing else in life. And this is how the distribution happens, bringing you an euphoria, because they need a lot of liquidity, right? So this is how the distribution would happen. So understanding in detail accumulation phase, it is a sideways range in which institutional smart players buy carefully and skillfully without moving the price. The small players are unaware of what is going on. They have left stock market forever, and the market is out of the public focus while under accumulation. From a technical perspective, prices move sideways in a trading range bounded by rough areas of supports and resistance, right? So this is what would be happening in the accumulation zone. Then markup phase, there would be a classical uptrend. At this point, the small scale traders become aware of the price movement and their buying fuels price action higher. Smart money players who bought in the accumulation phase may sell some of their holdings into the strength of the uptrend, or they may just hold and wait for higher prices. As the trend grinds higher, the early aggressive shorts will be forced to cover, and their buying pressure will in turn push the market even more higher, right? And then will come a phase of distribution. So it is exact opposite to accumulation. It's a sideways range bound market activity that happens after an extended uptrend. This is the phase where smart money traders and big institutional players try to distribute or sell off their positions without moving the prices too much to the downside. So this was about the distribution phase. And we need to understand, again, don't believe anyone. Just try to see that are we in a distribution phase. We'll see Nifty charts and some important charts later on. And we will ourselves try to understand that where are we. Then learning from some macroeconomic data, that is the leading economic indicators of a recession. So one of the most important leading economic indicators is inverted bond yield spread. And so let's understand this. If I invest in a bond or in any debt instrument like FD for a small time, I should get small return. And if I invest for a longer time, I should get more return. But what happens here is when the inverted bond yields happen, that you are getting more return on the shorter span of bonds than on the longer span of bonds. Now, this is a indicator of recession, a leading indicator of recession, and it has not failed in the past 60 years. So this is 10-year treasury constant minus the 3-month treasury constant. We also see the 10-year and 2-year spread, and we have never seen it failing except for once, the 10-year 2-year spread in 1960. But apart from that, we have never seen it failing. Whenever we have seen inverted bond yield curves, we have landed up into the recession, and this has been so far the most steepest indicator, right? Steepest fall, steepest bottom of inversion of the bond yield curve. And when do we see recession? When do they call off recession? When this inverted yield curve starts uninverting, right? When the people have left the stock market, invested in bonds, then the bond prices will go up, the yields will come down, and finally when the inversion would get uninverted, at that time a recession would be declared. So all these gray areas in the background, they are the times of the recession, right? This was the 1990 recession. This was the dot-com bubble. This was the global financial crisis. And this was the COVID recession, right? So what are the leading economic indicators in US? So there are certain components which make up the leading economic indicator, like the credit index, the stock prices, interest rate spread, right? Then the non-financial components like average consumer expectations, index for new orders, building permits, average weekly hours, manufacturing new orders, all these things. And what has been historically seen is that whenever we see a leading economic indicator going negative, it has landed up into the recession, right? So as you can see, this is the YOY percentage change of LEI, and the gray line is the GDP. And as we see that whenever LEI has turned negative, there has been a recession, right? And YOY change in real GDP has then subsequently fallen. Okay. So again, as we saw in 2020, as we are now seeing, the leading economical indicator is negative, though the GDP and the stock market is still, here. But then maybe we are seeing the last uptrend, and maybe we might see that this can again lead up into the recession. Again, we are only reading the history. We are not speculating. We are just seeing that what has happened in the past, and will the history repeat itself? Or the most dangerous statement, maybe this time it's different. We don't know. So negative LEI signals a recession. And again, in October 2023, we have been seeing that, there is a recession signal which is on. And again, this is the inflation. Now, markets were really celebrating in US that CPI, consumer price index, CPI, which is a marker of the inflation, has come to 3.2%, and they had forecasted as 3.3%, and the previous was 3.7%. We are again forgetting that the target of the Fed is to bring the inflation down to below 2%. So we are still nowhere near the target. And this is the lifetime chart of the inflation, right? And what we have seen is that after the COVID printing machine of notes, we saw that the inflation went up till 9%, and then the Fed started tightening the rate, and the inflation has fallen down from 9 to around 3.2, but still, it is still nowhere near the target of Fed, and the Fed will keep these interest rates higher for longer. It is very interesting and very compelling, like attracting to believe in the news. Now the Fed will not decrease the rates. Now the Fed will decrease the rates. All those kinds of speculations. What history tells us, not to believe the news. What history tells us is to see what is happening ourselves. Everything is there on internet. We just have to Google and see what is the CPI and what is the rate and what is happening. And we don't have to believe in what the news says, right? So again, something about the leading economic indicators, and these are some experts from reliable charts, which I have again back tested on internet. So whenever the Fed pivots the rate, whenever the Fed says ki, okay, ab hum interest rate nahi badhayenge, it is actually at that time when the recession has come in. So let's see whether this time it is different or not, because the mortgage rates, the time duration, it actually starts hurting you over later period of time as your maturity dates are coming near. It is at that time that the default rates increase. Okay, so investors' purchase of US homes are falling quickly, and now they are at 2008 levels, right? And banks lending off has fallen off a cliff and is now officially in a contraction territory. And this has happened only once since 1955, and that was during the Great Financial Crisis, that is GFC 1, that is 2008. And again, they have contracted to similar levels. So again, we need to wait and watch and see whether how far is the possibility of landing up into GFC 2. And again, with so much of noise around in the market, I would say just have a look at the inverted bond yield curve. And if the bond yield curve is still inverted and the market is at that top and not as the bottom, then I think one should be really cautious. Then one of my favorite parts to backtest and check, and I call this as the script of GFC2. Let's see whether it will play or not. I think we'll learn a lot in coming years. That what is the role of mainstream media, news channels, newspapers, and analyst recommendation. So we all read this story of Vishwamitra, and we know how Menka attracted Vishwamitra and interrupted his prayers. This picture speaks a lot. I think the influencers, Twitter, Telegram, lots of Menkas are around. and they really don't want you to compound your wealth, and they really don't want you to have an aversion for risk, right? So from today's WhatsApp group, right? So this was being circulated everywhere that foreign brokerages see that Sensex will come at 86,000 in 2024. So who are saying, Goldman Sachs, JP Morgan, Nomura, CLSA, they all are saying that, Nifty per neutral se badkar raha hai overweight, and Bharat ki sabse zyada growth, better emerging market, and all this news is being sold. Then I really want to know from Morgan Stanley and Goldman Sachs, by the way, their own CEOs have sold their stocks recently, and why then they have been selling the stocks in the last 3 years from Indian equity markets. 2021 they sold 92,000 crores. In 2022 they sold 278,000 crores. 2023 so far they have sold 60,000 crores. Why? कथनी और करनी में इतना फर्क क्यों? So again, I would say that news, read it as a contrarian. Any WhatsApp social media forward, any WhatsApp made being viral, read it with a pinch of salt, that why this news is coming at Nifty at 20,000. Where were all these paper clippings and everyone when the Nifty was at 15,000 or at 16,800, right? So again, see what they do, see if the promoters are selling, see if the smart money is selling, right? So recently, Mark Zuckerberg, he dumped $137 million Meta shares, right? This is very recent, from 23rd November. Then in August, we saw this, that promoters in 2023, we have seen promoters selling a whopping 10 billion. Again, now they're not talking about it. They spoke about it in the early days. And Jamie Dimon is selling off. Jeff Bezos sold his share. Now I have dropped in the chart when Jeff Bezos sold. It's very interesting. Jack Ma selling his shares, right, of Alibaba. Warren Buffett sitting on record 157 billion of cash. Probably nothing, yeah. So let's see, when did the news of Jeff Bezos selling his shares came? It came on 7th of November 2021. And this was here, right? 8th of November, I have tried to see. And after he sold on the top, they know when is the top, right? He sold on the top, and Amazon stock corrected 54% from there. So just imagine if you would have bought here on the top, and if you had not kept a stop loss of 8%. Just a learning. So Buffett has built a record cash pile to deploy when the economy tanks, and these are very, very recent updates. I've also seen the Berkshire Hathaway's monthly update, and his cash build means he'll well placed to snap up discounted stocks and businesses and loan money at attractive rates if the economy tanks. And right now, he is anyways invested in bonds, which are giving him good returns. Again, finfluencers, IPOs. So this is very interesting. They're trying to hold the Nifty on the top because they wanted to bring 6 IPOs. And it was a very interesting Economic Times, every page there was an ad of one IPO, every page. So very interesting. We'll see how these IPO perform by the end of next year. It will be a lot of learning for all of us to see. We don't know, but again, we'll see. So greater fool theory, what it means in investing with examples, like it argues that the prices go up because people are able to sell overpriced securities to greater fool, whether or not they are overvalued, right? So people forget about the valuations, people become greedy, they start ignoring everything and try entering into risky assets on the top. So again, Diwali mania is also, bought and sold a lot in India. And this is just last 1 year's performance. And I tried to see what happened after Diwali. So I think, again, that would be a confirmation bias. On some years, there has been a Diwali rally, some years has been not. So very difficult to come to a conclusion on a scientific basis. So last year, Diwali to Diwali, Nifty gave 6.6% returns, but gold gave 16.21% returns. That is in US dollars. If you talk about an INR, gold gave 18% returns. So sentiments in Indian stock market, Diwali and election. So a lot of things were about election rally. So and very beautifully, you know, some of our influencers who are talking about Nifty at this, Nifty and that, very smartly they said that GFC2 was an exception. Let's not talk about that. And they very smartly said that we have adjusted for COVID impact and asterisks. And this was the heading banner of their YouTube video, election bull rally starts, you know. So it's interesting. I mean, I don't know what will happen, but it's just interesting. And I want to bookmark these things. And a great Purvish sir, you're giving an opportunity to make these presentations. And I think we'll learn a lot over the years, seeing these slides, you know, back. I think we'll learn a lot. We'll connect a lot of dots. So FIIs mean a lot in Indian stock markets, and they come to the emerging markets when they get returns more than their bonds, more than their own stock markets. And for that, we need a dollar index, which is not strong. So if the dollar index would be weakening, they might get some value coming to the emerging markets. But right now, their own bonds are giving them nice 5% returns, which they have not seen in last 40 years. That was, you know, long back that they saw this 5% returns. So they have to have a reason for coming to emerging markets like us. So either the dollar index should really weaken down, or the Nifty's valuations should be very attractive, like the way it was in 2019 and 2020, or there should be a recession, another crash, and then they might find some value in emerging markets like us. So we need to understand they are 8 times bigger than our economy. We are somewhere around $3.4 trillion economy. They are $24 trillion economy. So they really need reasons and safety to come back to us. So recency bias, you know, take every news with a pinch of salt. I would say that news is something which is most deceptive, and it can help you more if you use it as being a contrarian, you know, like a Mint 6 days ago, FIIs buy Indian equities for second day straight. I mean, come on, no one is talking about this. What they have been doing for last 3 years. Come on, man, talk about this as well then. So we have to take everything with a pinch of salt. Like one day ago in investing, we saw strong FIIs flow associated to market making new highs. Take everything with a pinch of salt. That's, I think, one bottom line, one key message which I want to give everyone, that don't just read anything which is forwarded to you. Understand that if it is coming to your inbox, the intentions are not right. Because when they will be actually buying value shares, they will be hiding it from you. They will not be telling you. So a role of derivative markets in India in deciding the short-term trends. Recently I'm trying to decode and understand what the language of options is. And I think I'm listening to Mr. Abid Hassan, who is the founder of Sensible. And I find him sensible because he is off the equity since September 2021, since the market top. He is in government securities. And I like listening to him. He seems to talk and make sense. And this is interesting. I think if you really want to understand, interpret option data, I think hearing Abid Hassan every night, he comes around 9:30 p.m. I think it's a good learning experience. I wouldn't say that again everything should be taken as it is, but it's a good learning experience. So now, after we read about Stan Weinstein, we read about William O'Neill, we read about Howard Marks, we read about Wyckofian. What do we see here? This is Nifty's chart, and this is in US dollars. Let's talk about a global emerging market. What do we see here? Right? I really want everyone to take a pause of 30 seconds. If you have listened to whatever we have discussed right now, and just take a pause of 30 seconds and just watch it. Are we in an accumulation phase? Are we in a markup phase? Are we in a distribution phase? Right? Probably, I may be wrong, probably this was the accumulation phase, right? The worst of COVID crash, all bad news around. where the FII started accumulating here. The smart money came in, jumped in. This orange line is the 10 months moving average, right? Another theory is of 10 months moving average. So 10 months moving average took a U-turn, a sharp U-turn. Prices came above 10 months moving average, right? And obviously, if we see a weekly chart, it would have come above 30 weeks moving average. And we saw one of the smallest recession of our lifetime, an exceptional recession, because they started printing money. Because of the COVID, they got a reason to print money. And interest rates were cut off like anything, zero interest rates. And we saw this rally. We saw this beautiful rally of Nifty coming from $100 to around $240. This was the top of Nifty in September, October 2021, right? Double top made here. Then we saw dips. We saw dips of 15,000, 16,800. And again, it was the FIIs who finally came in and gave this rally of for a March till September rally. We owe it to FIIs. They came in for 4 months, right? This rally, we owe it to FIIs. So, and again, we are here in dollars. We are seeing, we saw one top of September, 15th of September. Sorry, this was of August, then of September, and then a sharp dip of October, and there we are here in November. So again, I would say just take 30 seconds, watch this, imbibe this. Don't listen to me. Don't listen to anyone. Just drive your own conclusions and try to understand what these charts are trying to tell you. And is top se aur kitna top par jana hai? You know, are we finding value? Are we getting something really interesting here? Then this is again Nifty monthly chart for the last 5 months. 1, 2, 3, 4, 5. We are here. We are same, right? We are just here for the last 5 months. This is again Bank Nifty chart. We have seen that the Bank Nifty, this is the weekly chart of Bank Nifty, and we see that it had a broken 30-week SMA. There has been a pullback rally, but again, we don't know where we are going here. S&P 500, again, it is trying to have another rally here. Probably this is again another distribution to a bull trap. We don't know. Time will tell. Again, this is here where we are with the Nasdaq. This is here where we are with the Dow Jones. Similar patterns, right? So again, only time will tell where are we, but we need to ask ourselves, am I in accumulation or am I in distribution? Then portfolio rebalancing. Again, this is very important that as per my age, as per my returns from the markets, like how do I adjust my portfolio? For example, if I have been a long-term investor and I've been an SIP investor and I pumped in a lot of money in the 2020 COVID dip, and now my stocks have made 80% of my portfolio, my FDs or my bonds or my cash position has narrowed down, then should I rebalance my portfolio? Should I, cut down on my equity, increase my cash exposure, increase my bond exposure, increase my gold exposure? That we all have to talk to ourselves, right? Then again, age, 100 minus age. So the younger you are, the more you can, easily invest in stocks because you have a longer term horizon. But if you are in your 50s, then 50% in high risk returns like stocks is fine. Rest 50% should be safe in like government bonds or in FDs, right? So portfolio rebalancing and is very, very important. Asset allocation is very important. And every year, every 1.5 year, 2 year, you should try and sit down and see that how is my asset allocation happening. Now, this is one again interesting chart of Nifty versus gold. So Nifty is in pink here and gold is in blue here. And what we see since 2002 is that whenever we see that, we see a swap, we see that there is less divergence, they are coming close to each other, and the gold returns are getting better and Nifty is at the downturn. These are the times, when these charts touch each other, these are the times to go really long on equity. So maybe this is the time to really accumulate gold. It has been consolidating since last 3 years, and it made a top at the COVID dip. When the equities were dipping, the gold had topped, and now Nifty has gone like 100% from here, and gold has been consolidating. So we need to ask ourselves that is buying it here a sensible option or not? And when it comes to bonds versus equities, now this is the 2-year bond yield in a 3 monthly time frame. And this is so interesting. Like only after 2007 we are seeing the bond yield so high. So we keep on buying in the newspaper, wo bolenge bond yield come ho gaya, come on man, like from where are you talking? Is that recency bias? What am I comparing to? So again, as you see here, 2-year and 3 months bond yield are 4.8% and 5.4% respectively. They are more they're more than the longer term bond yield of 10 years and 30 years. They're still more. The curve is still inverted. And this is the 10-year bond yield. What an interesting chart. I think I would frame it like 1948 onwards, they had increased the interest rates, gone up till in 1984, gone up till 15%, 14% interest rates. And since then, they have been on a reducing spree, bringing it to like 0% by 2020. And how they have decreased the value of dollar. Dollar has depreciated 90% in all these years. And now see the sharpest rally of bond yield curve or the interest rates ever. Now this is the sea change about which Howard Marks is talking about, from 1% straight up to 5% in less than 2 years. Interesting, isn't it? And this is the Nasdaq Bank Index about which no one is talking. They are again facing insolvencies. In March, we saw Credit Suisse Bank collapsing. UBS Bank gave a bailout. Central banks gave a bailout. But again, what will happen if some more banks collapse? This would be really very interesting to see. So now putting it all together, what do I do as a retailer? मैं क्या करूँ? Like इतना confusion है, कोई कुछ कहता है, कोई कुछ कहता है. So I think when we put it all together, I would say that just try to understand how are you feeling right now. If you're feeling euphoric, excited, then maybe this is not a time to go in. If you're really feeling sad, bad news all around, everyone has started hating equities, then that's the time to get interested. I think psychology helps a lot. So this is the bull market psychology, which we might see in ourselves right now. There's a renewed optimism, FOMO and euphoria, like a big FOMO when Nifty went down till 18,800 recently, and then very sharp up rally of 1,000 moves. We need to ask ourselves, where are we in the bull market? Are we in euphoria? Really, are we looking for this stop? Like, 1,000-point stop, Nifty may go to 20,500 again, 21,100 again. We don't know. FIIs and options data might do that. We don't know. But are we really taking all the risk to buy more here, right? So again, we have to, as a long-term investor, we really would have a great opportunity when there would be despondency and depression around. That would be the maximum financial opportunity time when there is all bad news around. So if I don't know anything, if like, I don't know, I don't want FOMO, I don't want that depression, so what do? I think the best way is to just continue your SIPs and mutual funds. Again, this is not a recommendation. This is just an example. Like, I have been invested in this mutual fund and it has given me more returns than my equity portfolio. So time to sit back and, itni mehnat karni hai kya? Like, if I really want to go into equity, if my mutual funds are giving me what 15-20% returns, do I really need to work so hard? Or if I really want to work so hard, then I should be on the right side, right? So this is, I think SIP investment is good. I think I'll conclude here. And these are good reads which I have just noted down here. I've shared the link of the presentation already. And just to conclude, me being an Osho sannyasin since the age of 13 years, I have to come up with an Osho quote at the end that don't make my conclusion yours. You should try to understand me. You should try to learn, but you should not collect knowledge from me. You should not collect conclusions from me. Right? That's all I have to say. Thank you so much for patient listening. Lessons in life will be repeated until they are learned. Thank you.
Thank you very much, Srishti. This is really an exhaustive analysis of what is happening in the global market and also its relevance to India. We now have 3 experts, and I'll ask each one of them to, give their comments. We'll start with Dr. Arjun Singh Chib, who's from Jammu. He's a medical oncology colleague. And Arjun, I would like you to comment on what is your recommendation for the Forex investment in today's scenario?
Hi, sir. First of all, hi, everyone. Forex, basically, market is a huge market in the world. As we know, the 6 trillion transaction daily in Forex market. The reason why I started at the Forex market, basically, during working hours, there is a less of time for me to trade in the Indian market, especially in the morning time. And then I look out the other market in the market world, and then I see the Forex market, which is very much adjustable to my time, especially in the evening. I do the trading or investment in the Forex in the evening. That's why I started the Forex market. I know from the first day, the Forex market is illegal in India. But there is a way to do Forex trading like Indian players, Indian currency. We do the Forex trading through SEBI registered brokerage firms like in Zerodha, like in other apps, in Indian pair currency, like INR pair. And again, why I interested in Forex market, basically the oil market and the gold market and the US market specifically, and along with the dollar index. These are in the Forex market, traded in Forex market. From that Forex market, I will conclude about the direction of Indian market, anticipatory. And that's why traded in the Forex market. I usually do trading in Forex market, investment not likely in Forex. But from that Forex market, I draw some conclusion regarding the Indian market, and so that I can invest in Indian market. That's why I started Forex market. And definitely it helped me a lot. From the last 3 years, I do the Forex market, Forex trading. And especially I know the movement of gold very much well before the Indian market. I know the movement of Indian market. Specifically, we know the US market is 24 trillion market, but US stock exchange market is 50 trillion market, and Indian our market is less than 4 trillion. And the Chinese market, again, up to 18 to 25 trillion. So they are huge market, and everything which will be impacted in US, that definitely reflect in other market also. So all things I did just basically to analyze Indian market better way, to invest in Indian market better. But unfortunately, I started Indian market in 2021 first time. 2021 September. Since then, there is a sideways in the market, roller coaster in the market. But my take on specifically from investment point of view, he never do intraday trading. As a professional, we are also in this field. Never do intraday trading. Always prefer do in positional or swing trading or long-term investment, 3 to 5 years horizon. And for there is nothing in the bottom or top in the market. We should invest as per our target, as per our target in our mind, as per our target. And also in either investment or either this is in swing trading or position trading, always kept in mind, have the stop loss in everything. Have in the mind stop loss. Where is stop loss? We have to put stop. Don't be emotional with any stocks, any investment. Just have your stop loss. Risk management, biggest thing in the market, which I learned after trading for the last 3 years in the Forex trading. Risk management is top thing. But what we do, I think in the past I did the same way. We do investment in any company and we stuck on that. Despite we have a loss of 40%, 50%, 60% and draw down the money, but we're still in that company. Like I have seen my friends in the Yes Bank 330, still now they are still in the Yes Bank up to 5. They have reached in the, I think, 2 years back. And Vodafone, and there is a lot of companies. We always have in mind profit and the target and stop loss in our mind, so that we can exit and enter in the same right time in the market. So for me, everyone should have the learn about the market. And everyone should have invest in the market, but investment should be in the profit and target, in profit target and stop loss in our mind always. And again, there is no any bottom, there is no any top in the market. Nothing is there in the market.
Thanks very much, Arjun. We now move on to Dr. Randeep Singh, senior medical oncologist from Delhi and Gurugram. Randeep, what is your opinion about gold in the current scenario?
Sir, I'm as Srishti and everyone has mentioned, I will just tell what I do. I may be right, I may be wrong. There are two ways we can invest in gold. One is SGB, which is called sovereign gold bonds. They are more like a debt instrument. Sovereign gold bonds can be, this is one of the way when you want to keep the risk low. Always buy a sovereign gold bond when the gold is low. You can follow the technical analysis and the charts what Dr. Srishti has taught us. So when you want to buy, you have to see SGB. SGB can be bought from the primary market or secondary market. The primary markets are when the RBI issues SGB. Secondary markets are through your broker. When someone has bought SGB, you buy and sell like a stock or an equity. SGB comes in a series, like I have an SGB August 28 5 series. That means SGB is sovereign gold bonds. August 28 means they will expire in August 28, and 5 is the trenches. This is the nomenclature. So it's not very difficult one to remember. The SGB will expire after 8 years. So you have to keep that in mind. Suppose I bought it today, the maturity will be after 8 years. If I buy it from the primary market and sell it after 8 years, then whatever the interest rates and benefits, there will be no taxation. The interest rate is usually 2.5%, which you get it, but it is not the interest rate. If someone talks about here, so everyone is talking about 20%, 25% return. The gold will also increase over 8 years. So this is apart from the interest rate, your capital also increases. You can also buy from secondary market. I have bought SGBs from secondary markets. When I buy from secondary market, you have to keep 2 or 3 things in mind. One is the issue value of that. You can go to the net. Suppose I will talk about SGB August 28, which I bought recently. You have to go to the issue price, that at what issue price it was there. Suppose that was issued 2 years before, then you have to calculate the interest rate at 2.5%, and then you have to minus that value. Suppose I bought it for 1 lakh, and then there is or I bought it for 1,000, there is a 2.5% interest rate for 2 years. I have to minus that 5 rupees, or suppose 100 rupees thing is bought, so that 2.5 rupees I have to minus. So 100 minus 5 will make it 95. So the fair price of that SGB shall be less than 95. It should be always less than the current SGB series which are issued. So this is one way. Why I deal with SGB? Because I do a lot of FNOs, future and options, and you can pledge SGBs. Pledging is that you keep it borrow with your, I will keep it very simple because we may have a few people who are not used to these terms. Pledging is that you keep it with your broker as a borrow, as a guarantee, girvi rakhna, and they take 10% cut. I mean, you can say 10% interest की मैंने SGB 10 लाख के गिरवी रख लिए, उसने मुझे 10 लाख का 10% काट के 9 लाख दे दिया. So that 9 lakh rupees I can use it as a margin where I can buy my future and options. And the advantage इसका ये रहता है कि your SGB will keep on growing as the gold keeps on growing. So after 4-5 years when I take out, I will use that pledging and borrow रख के जो मैंने use किया है, after 5 years I can gain that thing. This is one of the way to deal. I have to cut it into 5 minutes. Second is the equity way. That is the futures. I do deal with gold futures. This is purely a future option. Gold future is always issued in 3 months. One is the current month, such as November, then is the next month, which is December, and then is the far month, which is January. You always have 3 options available. What I do in gold is that in futures, I buy and roll over every 3 months. I understand that there is a loss. Some people don't agree with the rollover concept. So suppose I would have bought gold future when the gold price was 48,000 2 years before, and I keep on rolling the future till 2 years. That is a long-term vision, and it is not a trading which I do it daily. So every 3 months, if I roll over, I will have the cost 4 times a year. I will keep on rolling the future till my target is achieved or till I need money. And that is the other way of investing. When you go into futures, you have to be very, very clear that you understand what the futures are. You have to know what is contract value, what is the lot size. You can start in a short, I will say there are gold petal, gold mini, and gold, some gold, only gold. Gold is 1 kg. A retailer cannot buy 1 kg of gold. I usually deal with gold mini, which is 100 grams. To understand, the best would be start with gold petal. It is 1 gram. The contract value will come around 60,000 of a gold petal. That contract value means the value which you are buying into lot size. Actually, I will not go into the details of future because future requires so many things to understand. Future needs that what is your contract value. If the contract value of a gold mini comes around 60 lakhs and the margins is around 60,000, but if you keep only 60,000 in your amount in your bank and you think कि 60,000 से मैं एक lot खरीद लूंगा और कल जो है war खत्म हो गई और उसका, I mean, this is all macroeconomics. If you don't understand macroeconomics, please don't get into gold and forex. Gold and forex works more on macroeconomic, less on India. If the USD INR will rise tomorrow, there is a 1% increase in the Fed interest rate, the gold will fall. That is sure. If tomorrow another war starts, gold will increase. Gold is the safe haven. USD INR and gold, they always go opposite. Crude oil correlates with gold. You have to see all these things. You have to see the macroeconomics data and then invest. For investing in future, you have to be very clear that you keep at least three times money. If your margin is 60,000 of one gold met, then at least keep 1.8 lakhs, 2 lakhs in your account so that in between your operation theater or OPD, you don't get a margin call. One more thing before I close. Before I close, because I have to wind up and give another speaker a chance. I just slipped out of my mind that yes, if you are investing in gold mini, please, I have seen people making mistake. Please remember this sentence: gold mini, if you are buying of December, it will expire on 5th December. And your broker will square off 1 week before. So don't think ये दिसंबर के एंड में एक्सपायर होगा. गोल्ड मिनी बहुत अलग चलता है. गोल्ड मिनी में अगर आप खरीद रहे हो तो प्लीज रिमेंबर दैट गोल्ड मिनी इज एक्सपायरिंग ऑन फर्स्ट फ्राइडे ऑफ द मंथ. अगर दिसंबर का गोल्ड मिनी लिया है तो 5 दिसंबर को एक्सपायर हो जाएगा. एक हफ्ता पहले आपका पोजीशन स्क्वायर ऑफ हो जाएगा, ऑटोमेटिक स्क्वायर ऑफ कर देगा Zerodha speaker. So just remember, you need to know a lot of things before going into future. Better is to go into SGP. That's all, sir.
Thank you very much, Randeep. I think sovereign gold bond also has the advantage from taxation point of view, in both in terms of GST and in terms of what you save in terms of tax. So that is a very good recommendation that you've made.
Yes, sir. I will just make a small sentence. If you buy the short-term, long-term capital gains are 1 year. If you buy from the secondary market and sell in the secondary market within 1 year, you will have a short-term capital gain. After 1 year, short-term capital gain, the taxation will be as per your slab rate, whatever bracket you comes. If you sell it after 1 year, then it is a long-term capital gain, and then long-term capital gain also comes with the taxation benefits and others.
All right. Thanks very much, Randeep. For the conclusion, we have Dr. Avinash Talele, also a medical oncologist, but he is also a certified, he's got 2 certificates in investment and finance. So he has a lot of insight into this and what to do for the retail investor in today's scenario. He will be the right person to conclude. So over to you, Avinash.
Thank you, sir. Good evening, everyone. So the topic today is very interesting. It is about risk management. And I will just, can I share my screen? Just
Yes, please. Go ahead.
So is my screen visible? I guess it is visible.
Yeah.
So
yeah, we can.
Today's topic is risk management. So I just want to distinguish what is risk and risky. So there is a very small difference between having a risk and risky. So I'll just give an example. So there is always an inherent risk to cross the street. Like you risk, there is a chance of getting an accident. But if you cross the street by closed eyes, it is risky to cross the street with the closed eyes. You will definitely land in an accident. So that is a very subtle but a very profound difference that I want to highlight today. Why I am saying these things is I just want to draw an attention to 3 things. There are 2 types of risk when we enter any market, any asset class, whether it is equity, whether it is gold, any commodities or anything. The risks are systematic and non-systematic risk. So what is non-systematic risk is, it is that risk that can be mitigated, or like say in equity, how much stocks should we diversify so that we can average the unsystematic risk. So statistically, if you ask, the number of stocks needed in a portfolio to offset unsystematic risk is between 18 to 22. You do not need more than 22 stocks in your portfolio to mitigate the unsystematic risk. Systematic risk will always be there. So that is the minimum amount of stocks that you can need to diversify so as to gain an alpha over your investment. Now what alpha is? It is the level of outperformance over the benchmark index. Second, a very critical thing I want to share, which has been highlighted by Dr. Srishti here, is she said you need to cut your losses, and there are saying by the great peoples, you flower the plants and cut out the weeds. So I just want to share with you the impact of the drawdowns and how it impacts the overall portfolio. So usually we have to cut the losses short. Whenever we take a position, which on any system, be it on a 30 days weekly moving average or anything. So keep the losses short. The intention is whatever is our rationale with that we have entered, market is not respecting that. Our hypothesis is probably not correct this time. So get out with a minor loss. So here is a chart which is depicting a drawdown of -5 if you have in one equity or one trade. You will need 5.3% returns to get it to break even. Now that is still manageable. It gets very scary and interesting beyond 50%. So if you have a -50% drawdown, it takes 100% gains to get back to break even. Now getting an 100% gains can take a lot of time, maybe a year or maybe more than that. Till that time, your money or your asset is not performing. So your equity curve is under the water. So you don't want that to happen. Interestingly, when your losses goes to 90%, see what is required to get at back at break even. It is 900%. That is huge. So cut the losses short. That is the best for any entry or any trade or any investment that you do. There can be only four outcomes: small profit, big profit, small loss, and big loss. So even if we avoid big losses, we are in the game. That is the first thing. And second thing, what I wanted to share is whatever system you use, like you breakout system, what Dr. Srishti said, that getting out of that Darwa's box or that consolidation or accumulation. Now that has been described by various authors in their own style. Like some they call him Wyckoffean accumulation, some of them they call it as Darwa's box. Now that is an subjective way, but how to get that objectively in the market? Because we need a system which will be repetitive, replicable, and consistent, because we are dealing with our hard-earned money here. So for that, there is something called as market breadth. Now, market breadth also is one of the parameter. So what market breadth tells us, assuming Nifty 50, we apply the market breadth to Nifty 50. Before the market tops or just near the market tops, what happens is market breadth also starts falling down. What market breadth is actually, out of those 50 stocks in Nifty, how many are making a new high and how many are making a new low. So when the market breadth is getting lower and lower, lesser and lesser stocks are making highs. That is a time where that also correlates to an extent with the market tops. So similar things can happen with other indices, say Nifty 500 or stuff. But even though Nifty is sideways, Nifty has not made a money. That is not a problem. But still, you can still get your next multi-bagger here, because there is a saying that there is always a bull market somewhere. Okay, even if Nifty is not performing, there are certain policy stimulus, there are certain sectors where the money is coming in and your money is growing. To give an example is beverages and ethanol, some of the stocks where the stock has been at least that it has at least made say 300 or 400% gains in the last 2 years. Say power sector. Now, even in that power sector, there are certain companies which are dead, like they are not moving a dime. Say Reliance Power, R Power, it is not moving. It was at rupees 15 1 year back. And at the same time, there is something, there is stock, I'll tell you, I bought at ABB Power. It was at around 1500. Now it has touched, I think, 4000 something. So it has become almost 300% gains are there. So as an investor, my intention is always to, if I am wrong, I should be out with minimal of losses. If I am right, I should ride it and make it large. So our job is to make smaller mistakes. And if you're right, you need just 3 stocks to change your fortune. And make them ride them big and handle them well. And the last thing I will say is the importance of drawdown, what Dr. Srishti has said. There are various strategies. You can choose any of them that suits your personality. So the only enemy here is ourselves. The enemy is not the market. The market, the enemy is us. It is our emotions which come in between and help do our wrong decisions. I'll show you one strategy A. So there is 100% gain but 25% drawdown. So because this person I am in 100% gain, he broke the rule. of getting out. He avoided getting out early. Another person, the same stock, but he got out early at minus 12% drawdown. The stock is at the same, almost same level. Here the net gain is 125%, but here, because he has got down out early, and here the net gains is 162%. So they are the same stocks in the market. Everybody knows their names, but everybody cannot handle them properly. So handling them properly will make all the difference. It will separate men from the boys. And one of the ways to find out that is something called as Monte Carlo analysis. With that, we can test our systems in a way whether this is actually making money for us or not. To give an example, if we flip a coin 50 times, 100 times, we will get say 60 heads and 40 tails, right? So that does not mean our strategy's hit rate is 60%. If we do that again, we might get 55% heads and 45% tails. So those, all these probabilities are factored into that Monte Carlo analysis, and we get out hit rate and the net profitability rate and number of sequences where we will have losses. If the losses what you have calculated on a Monte Carlo and the market are different, stop that strategy. It is not working, and you have to figure out a new way of doing that. So that is something called as quants. That is also a very interesting way to learn and understand the markets, and which will help us to handle the money efficiently. With that, I conclude my talk. Thank you everybody for the patient listening.
Thank you very much, Avinash. After listening to all the four experts, what I'm going to do tomorrow is to be very cautious about purchasing any new stock as of now. Whatever liquid money I have, I want to make sure that it remains liquid. I will put it as SIP in mutual funds and perhaps a little bit in bank bonds and gold. So no stock market right now till I'm sure that FIIs have stopped taking out the money. Maybe wait till December or January. And in the meantime, park the money in mutual funds. So that's great. Thank you very much. And as usual, we'll continue with these sessions on the 4th Thursday of each month. Next month in December is going to be in Christmas time, so we'll avoid that. And therefore, we'll have our next session in January. With that, good night, everybody. Take care and happy investing to create wealth.
Good night, sir. Good night, everyone.